Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. We've got a little bit of a early morning pre-bell rally, and you can definitely see that around 6:30 this morning Eastern, so roughly 2.5 hours ago, we started to see some strength. Now, this morning at around 20 after 8, we did hear from one of the Bank of Canada governors. That certainly didn't hurt, but overall, this just appears to be a pretty clean bit of follow through after yesterday's surge. So yesterday's surge, of course, followed Friday's sell off. Prices remained above the white dots of the top tier propulsion. That's the equator again. That for me is separating that bullish hemisphere from the bearish hemisphere. And we're trading above yesterday's previous session close. So, right, the PSC at 18,722 and 3/4. Not much above it, but certainly just a bit above, staying above that. And I'll keep a little bit more of a bullish outlook. And that's where we start this week in September. Certainly not as bad as Friday might have the close from Friday might have alluded to, but definitely seeing a little bit more resilience as, in fairness, is this a sell-off in September? If you look at just September, sure. But if we step back and look at the range that was established from, say, the end of July to where we are right now, and just let go September and the seasonals and everything else, you'll see that we're really just stuck in a larger, choppy range. One that arguably we put the lows in for back in late May and put the highs in for basically in mid-July. And we're still stuck in that May to July range, even with you can see here with that unwind from the yen and the carry. This is really not bearish. It's not bullish. It's just a wide range where we're chopping atop what has been a pretty bullish 2024. And I think a lot of times, for whatever reason, that's been really lost on the larger conversation. Where are we now in September? We're not in a bad spot. We're just in a choppy season in the overall averages. Is everything the same? No, of course not. If we take a look at the NASDAQ, we know it's a little bit heavier than the Dow and the S&P, mainly because we've got the healthcare and financial strength helping the S&P and the Dow. And then two of the weakest sectors month to date are semiconductors and technology. Now, did Apple with the iPhone 16 announcement, what did they announce yesterday? New AirPods, new iWatch, and the iPhone 16, and they spent quite a bit of time on the Apple Intelligence. And one feature that I've always been surprised that they've never had on the phone, which is just a button to get the phone going, right? They got all these other buttons, but not one that's just a phone button. So they've got a pretty cool little button they added. Now, here's the thing. How many people will say, oh, I'm going to ditch my iPhone 13 now for the 16 or the 14 for the 16, etc. So is this the kind of device that would be considered what is often called the super cycle? No. Why do I even mention that? Because Apple is still, even though it's been supplanted by NVIDIA as a top dog stock in the XLK, Apple is still obviously hugely important. It's a magnificent 7, and where it goes is going to have influence on the S&P and the NASDAQ. And, where we see right now, this was interesting too. Usually in front of Worldwide Developers Conference and product announcements, it's not unusual to see Apple rally a little bit more convincingly into the event, but you can see where we sit. There's no reason for Apple to sell off. I mean, what Apple Intelligence is going to do for the iPhone is actually going to be pretty amazing. Yes, it's a slow rollout, but remember, traders are always looking down the pipeline, and there's no reason, as far as what I'm seeing with the event, nor the support. Right, let's just get down to it. How do we measure all this news? How do we measure all this these events, and staying above 217.50 is a big deal, especially within the context of a sideways market with neutral trend. That could be an interesting oversold level for Apple if we want to be a little bullish. And that brings me to another topic as far as this month. And that is, look, I'm not in any way going to kind of sweep under the rug and actually let me get the season X here. There we go. I'm not in any way going to sort of sweep under the rug the fact that we all know September is very often a really bearish month. But at the same time, remember, seasonals are not setups, and setups are not necessarily what's going to be giving us the entry, the stop loss, and the target for a trade. I think a lot of times traders start reducing trading to simply the target. As long as it gets to the target, that's a trade. And we know that if the journey to the target is untenable, if the risk to the target, if the sizing is off, we just won't get there. And, case in point, a lot of folks have seen The Big Short. Who's seen that? I mean, it's a fun movie. I look at that movie with mixed emotions, because what that movie did was celebrate top pickers. It celebrated traders who kind of use this prognostication type approach. Yeah, they did obviously very well, but the book and the movie I wish they would have written is how many other people had a similar trade as the characters in the book and the movie and couldn't hang on to the position while it went against them. And the road is littered. The book makes it seem like they were the only ones. That's not true. They were the ones that were able to succeed. Other traders saw the trade, just couldn't put it on in a way that was realistic to reach that target, which was ultimately, obviously, the financial collapse, what a target it was. But if you think about why, A, your account may not be growing, or B, why you're blowing up an account, unfortunately, that's all too common a scenario. It's oftentimes not having that risk component to the target fully fleshed out, where you say, all right, this is what the target is, this is what the risk is, and if I can make it there, it's going to be under these circumstances. And those circumstances, that formula is the difference between account growth and going, whoops, I blew up another account, which, by the way, blowing up an account is not a rite of passage. It's just a misunderstanding of the math to the target, right? So keep that in mind. And, again, I think when you look back on what was so celebrated in things like The Big Short, unfortunately, it's created this environment where traders think it's their job to somehow say, well, this is what's going to happen. And there's always been a little bit of that in stock market analysis, but never before has it been ridiculed less. And it really should be. Anyone talking about where things are going to be in December, it's ridiculous. It's the same thing as my asking, hey, who's going to win the Super Bowl or who's going to make the playoffs and what's the score going to be? All right. And yet in the financial markets, that's normal. That's accepted. And it's ludicrous. So what we want to remember is seasonals are not setups. We wait for a setup. We measure the risk, and then we see what's next. And, I will say this, 9 days in, 10 days in to the month, I was not anticipating having only long positions. We've only been long calls in the mastery, and still being up, and actually pretty nicely up on the month. So I'll share that with you all on Thursday, where we are so far in September. I shared with you all what we did in August. So when the S&P and the end of the world was coming around, what were we in? Why did we not have significant drawdown? And it's a lot of the same thing happening in September. We have nothing but long calls, and we continue to be growing our account, which is the job, right? That is the job. So let's go ahead and take a look at the Dow and also bonds. All right, here we go. So Dow take a look at that support right there, 40,268. I definitely keep an eye on that. One of the things that I was kind of bummed about, it was a winner, but I really would have liked to have still been in it. I'll look to get in again. And that is a long position on TLT and ZB. One thing that I'm likely going to start trading instead of trade this, not that, right? Is I'll probably start looking at bonds a little bit more than I have been with gold. Now, gold has been very good to us for the past 6 weeks or so, but I'm going to leave gold and relatedly gold miners alone now. And I'm likely going to start focusing on the bond long position. And we had one already, cycled out of that, and I'd like to look for another opportunity again. So kind of taking the gold story that was really good and accepting that it's our job to not trade the narrative of the thing we wish it was, right? And I if you want to know, Rog, what do you mean the narrative, the thing that Nvidia is a great example of, here's what I feel about it. Just let it go. Let it go. I promise I won't break into song. What Nvidia was through April into June is not what it is now. And so many traders are sort of going into, oh, the glory days, can we get back to that? Who cares, right? Whether it's Tesla, whether it's Nvidia, here's a great one. This one's hilarious. SMCI. Are people really still talking about this thing? Yes, it had a great beginning of the year. The broader averages had a terrific beginning of the year, right? And now look at it. So this is what I mean about saying, that had its moment. I'm happy for those folks who did well, but going back into it, expecting that move again, that's where traders get hurt. This is one of the best looking charts in any sector in all the averages. This is Coke, right? This is what we want to remember. We want to find things that look like this. Do we care about the symbol? No. That kind of goes back to account growth. If I'm running west looking for a sunrise, I'm not going to be too happy. If I'm trading SMCI looking for what it was in Q1, if I'm trading Nvidia looking for what it was in Q2, I'm going to be sorely disappointed, but I can find things that move like it. Put those names in your account, use the formula for risk to target, and then all of a sudden you say, oh, this trading thing isn't so hard. It's actually a very interesting thing where what we trade is far more important, right? If we put that watch list together, and that's where 80% of our time really should be spent. We put a really good watch list together, we're in good shape. And, kind of my preferring bonds over gold is the ongoing process of how that works. All right. So, have a Coke and I don't even drink Coca-Cola. You know what it's really good for? Oh, no. The last time, I'm trying to remember, the last time I used Coca-Cola was to clean, it does clean the battery gook off the connectors. I think I was changing a battery. It is very good for that. And, I won't lie, it's not too shabby with a little bit of rum. There you go. But one of the things, and actually speaking of soda water, Pepsi's been interesting, but it's not the same structure as Coke. So if I look at PEP and I look at KO and I take a look at what's happening with the range there, bullish side of the equator, absolutely. But is this the uptrend that Coke is? No. So we've got a long position in Pepsi, but we're taking some of the position off the table here as it's closing in on that 179.70. And I'll tell you, actually, I'll show you all right now what we've got. There we go. So we have Pepsi, 170 calls. We paid $3.55 for them. We scaled out once at $5.75. This is per contract, by the way, gang. And we scaled out again at $9.50. And I still have time, another 10 days to expiration. This is the way we want. And by the way, this is the way when you're looking at trades, when you're being presented trades, this is the way you want to look at them. What are all the entries? And what are all the exits? And notice what we do is we keep sort of a running tally. What did we buy? What did we pay? And what did we scale out at? And that's going to be per contract, right? So those are things that when you're tracking your trades, if you want to put them into a TradesViz, great, or a Wingman tracker, or a Trade Metria, or a Trader Sync, whatever it is you want to use, fantastic. And then keep a running tally. We do that every day in the Sector Secrets Mastery, and I send that out to the traders. all the entries, all the exits, right? So that way you don't have to kind of scroll looking for, well, what do we pay when we got in and what do we get when we get out? Everything's right there, really nicely organized. And it gives you a good idea of what I've done, and you can compare, what you're doing to what I've got going on in my book. All right. So next up is question on, hey there, Daryl. I've been tuning in for a week now. Thank you. I appreciate the time. I love your analysis, information, and humor. I try, Daryl. I'll tell you, this is my morning cup of coffee. This is how I get ready for the morning, and then go into the Sector Secrets Mastery. And I appreciate you coming and tuning in. No, I appreciate that. Philip asked, "What do I mean by risk to target?" Great question. Here's a common scenario, Philip. And if you want to know, so if you have a frenemy or an enemy, give them these two pieces of advice. Add to losers and use max debit. You're pretty much assured that eventually, TikTok, right? They're going to blow up their account. So risk to target stares down this very common practice of adding to losers. I'm sure they call it all sorts of things, reducing cost basis and averaging down. It's adding to a loser. Let's just call it what it is, right? And the other part is max debit. So whatever I bought, that's the full extent to what I've risked. All right. So risk to target flies in the face of common trading wisdom. And common trading wisdom is actually what's led to most traders, 90% of them, not succeeding. So why would we want to do anything that kind of falls in line with common trading wisdom in that regard? Yeah. So risk to target is this. How much of my premium am I willing to risk? Should it be all of it? Do we not think that maybe we'll know we're wrong on the trade before we let the option value get to zero? I think we do, right? By the way, as I like to call it, max debit management of risk is like it's like crashing your car into a brick wall and thinking that's the same thing as hitting your brakes. And that's a very common practice. So risk to target is how much of my premium am I willing to risk on the way to my target? So if that target, and here's another really common scenario, Philip. And by the way, my mind's really been on this a lot. We're going to be doing a conversation about this on the 24th and on the 2nd of October. And I'm going to talk about all the trades that we've taken in the mastery, show you a lot of that formula that we use to grow an account. Because at the end of the day, whether we're talking about risk, whether we're talking about a target, when we're talking about watch list building, it's all in service to the one thing all of us are here to do, which is grow an account. And that seems to be something that isn't discussed enough. Is the account growing or not? And what are the measurements and what are the formulas we need to know? All right. So how much am I risking to get to the target? Well, let's say I'm able to get 30% return on premium paid. So I paid whatever I paid, and I'm able to see that option appreciate by 30%. You might say, that's not too bad, Rog. You do that enough times, that's some nice incremental steady growth. I agree. But on the flip side of that, if your risk is 100% of premium paid, who here says, wow, for every 3 winning 30% trades, if I take one trade to max debit, I've evaporated that pretty much, right? And that's what traders do. Right? That's what traders tend to do. They'll risk 100% and they'll make 30 and go, see, we made money. But what happens is we're fooling ourselves, right? Because is that something that if we take over the course of 100 trades with maybe a 60% win rate, which isn't bad, even a 50-50, even something close to 70, can you grow an account with that? And you can't. It just is basic math. And that's where understanding risk to target is such a big deal. And understanding how much you could get stopped out at for a loss is going to erode any gains you make. Now, let's add one more thing to that. What if you add to that loss? This is part of the math. So if I get in and the markets move against me, so we add again. We trade options, right? A lot of us do. They're going to expire and they're a depreciating asset. So we're in a race against the clock. So what have traders typically done? What they do is they end up basically building a larger losing position. So not only are they losing, say, 100%, now it's a larger position than their winners. And again, when you think, gosh, Ron, yeah, that's pretty common. And then people step back and go, I can't grow an account. Do you see how those things are the culprit? And so if we can just openly address those things and have a better way of doing it, really, in a lot of ways, as classic as it sounds, it's a new way of thinking about risk and position sizing and targets and watch list building. Say, oh, okay, this is doable, but just not with the methodologies that traders like to practice. All right. Oh, my smoothie has arrived. All right. What do we got today? Blueberry? Blueberry. All right, gang. Have a great morning. I'm going to enjoy my blueberry smoothie. I'll see you tomorrow. Same time, same station. Be good to each other.